This module explores the fundamentals of loan structuring and problem loan management. In addition to the highlighted topics, this session provides the participants an opportunity to explore and discuss such concepts and tools as how lending rationales are used to guide the loan structuring process, tools for structuring short-term loans, including estimating loan tenor and amount, tools for structuring medium-term loans, including quantifying debt capacity, as well as estimating loan tenor and amount, role and importance of collateral, how to use financial and non-financial covenants to mitigate risk and preserve the lender's position. This session also provides participants an opportunity to examine an array of pragmatic problem loan management tools and concepts, including the big picture of managing problem loans, the objectives of managing problem loans, major causes of problem loans, profiles of problem companies, early warning signs, and strategic responses and tools for declining portfolio quality. While no lender intends to make a bad loan, all lending institutions should anticipate having some level of problem loans or loan losses. Our goal is to provide an overview of various issues and challenges regarding the management of problem loans, as well as a framework designed to help SME and commercial lender manage problem loans. During the workshop, we will explore how problem loans are managed in your market, how financial institutions oversee the problem loan management process, and whether there are techniques and procedures that enable financial institutions and their lenders to manage the process more professionally. Problem loans are a byproduct of the lending process. If an institution is going to lend money, it should expect some level of problem loans. The challenge that financial institutions face is keeping the level of problem loans within reasonable or manageable limits. Literature has linked the overexpansion of credit to banking crises. After periods of rapid credit growth, banks have experienced increased level of problem loans. It is generally agreed the greater the growth in a loan portfolio, the greater the potential risk. Consequently, comparing the growth of a portfolio to economic growth provides insight into the business strategy and risk appetite of a financial institution's management. Let's look at a few examples. This slide compares economic growth to portfolio growth. 3 cases are shown, and explanations or interpretations are provided. The first case depicts a situation where the portfolio growth equals the economic growth. In this example, the economic growth is assumed to be 5%, and the portfolio growth is also 5%. This example might indicate a financial institution financing the needs and demands of its existing customers. The second case illustrates a portfolio growing at a rate that exceeds economic growth. In this case, the economic growth is assumed to be 5%, whereas the portfolio has grown at 15%. This example would likely indicate a financial institution financing new customers, offering new products and services, and entering into new markets. Clearly, this scenario reflects greater risk than the previous scenario. The third case depicts a situation whereby the portfolio growth is less than economic growth. In this case, the economy has grown at 5%, however, the portfolio has contracted by 2%. This example would likely indicate a financial institution that is withdrawing from existing markets or customers. Hence, comparing the portfolio growth to economic growth, we can gain insight regarding the business strategy and risk appetite of a financial institution's management. What are the major causes of problem loans? Factors that cause good loans to turn bad can be categorized into three groups: external causes, internal causes, and lender causes. External causes include factors outside of the control of the company's management and the lenders. Examples of external causes include negative economic events such as high interest rates, recession, technological advancements, acts of gods, fire, pandemic. Internal causes includes factors brought on by a company's management. Generally, internal causes are attributed to such deficiencies as a lack of managerial, operational, or financial control, product deterioration, loss of market share, or not remaining competitive, or simply fraud. Lender causes include factors brought on by the lenders. These causes generally include improper loan structuring, inadequate or excessive loan amounts, failure to adequately monitor a loan, improper statement analysis, insufficient collateral, poor documentation, inexperienced lenders, and fraud. Given the different challenges associated with the respective customer sets, the one-size-fits-all approach is not applicable when managing problem loans. Managing large corporate problem loans requires a bespoke approach which is more akin to customer intimacy. Given the size and volume characteristics of a retail loan portfolio, a highly automated approach reflecting operational excellence is most suitable for managing retail problem loans. The highly automated and systems-driven call center model has achieved the best results for managing retail problem loans. Managing SME and commercial problem loans requires a blend of the automated approach used for the retail portfolio, operational excellence, and the bespoke approach, customer intimacy, used for the large corporate portfolios. Thus, the most suitable approach for managing SME and commercial problem loans is somewhere between the approach used for managing large corporate and retail problem loans, which makes managing SME and commercial problem loans challenging. Recall the diagram that illustrates the strategic segmentation of the financial institution's portfolio. The SME customer set was positioned between the retail and the large corporate customer sets. It should not be a surprise that managing SME and commercial problem loans requires a combination of the automated and bespoke approach.